Imagine you wake up tomorrow, open your banking app, and it just won't load. Not a glitch, not maintenance. The bank itself is gone. Sounds extreme? It's happened. To real banks. Real people. Last time, we found out your deposit doesn't sit in a vault. It's out there, lent 10 times over. So today, what happens when everyone wants it back at once? Here's a fun fact your bank will never put on a billboard. It cannot legally pay everyone back. At the same time. On the same day. Which is a business model that works great right up until it doesn't. There's a name for the moment it stops working. A bank run. Here's how it actually starts. Not with a crash, with a whisper. A rumor. Maybe true, maybe not. This bank's in trouble. One person gets nervous, pulls their savings. Their neighbor sees the line outside, gets nervous too. It's basically a financial game of telephone, except the prize for losing is your life savings. Within hours, hundreds of people are standing outside demanding money that, structurally, isn't all there. And here's the twist that makes economists lose sleep. The bank can be completely healthy and still collapse, purely because enough people believed it wouldn't be. It's the only industry where panicking about a problem creates the problem. This isn't theoretical. In 2008, it happened at scale. A bank called Washington Mutual, over $300 billion in assets, became the largest bank failure in U.S. history. In about 10 days, to erase the biggest savings and loan bank in the country. Imagine telling your grandkids, I withstood the Great Depression, 2 world wars, and dial-up internet, but a bad week in September got me. It wasn't alone. Lehman Brothers collapsed the same month. Panic spread fast, so the system was shaking. What happened next? The government stepped in with $700 billion, your tax money, to stop the whole thing from collapsing. Which, fair enough, nobody wants the entire economy to implode. But here's the part that should actually bother you. The executives whose decisions caused the crisis, many kept their bonuses. Fannie Mae and Freddie Mac alone paid out over $200 million in bonuses after losing billions. Somewhere, an executive got a participation trophy for breaking the economy. Meanwhile, regular depositors? Protected. If they were under the insurance limit, anyone over it learned the hard way what uninsured means. So let's zoom out. The entire banking system, every paycheck, every mortgage, runs on a collective agreement not to test it. That's not a flaw they're hiding. That's the foundation they're standing on. Deposit insurance, central banks, bailouts, none of that exists to make banking safe. It exists to make sure you never have a reason to test it. It's not a bug that the system depends on you not asking questions. It's the feature. So what does this actually mean for you? 1. Know your FDIC limit, $250,000 per depositor per bank. Above that, you're not protected. Split it across banks if you need to. 2. A bank run isn't something you can predict from a press release. If a bank is making headlines for instability, that's already late-stage information. 3. The system surviving doesn't mean you survived it unscathed. Trust who benefits from your trust. Next time, Silicon Valley Bank 2023. A modern bank run, and why once again the people who caused it walked away fine. The system worked, just not for you. Not a bug, a feature. Works as intended.